Focus on economics part 2 from a study point of view. In CFA, they will be looking at certain learning outcomes. Here we learn how to compare the monetary policy and the fiscal policy. Okay, we need to understand the key difference between the two policies and also what are the features of the policy, and importantly, describing the role of this policy in terms of how to impact the economy. The LOS on this is the roles and objectives of the fiscal policy. Also, we need to understand the arguments against it and how this policy is used. What are the tools of the policies and the various advantages and disadvantages. Okay. Now, before you start, what exactly do you understand by the word fiscal policy and the monetary policy? Now, as you understand fiscal policy, fiscal policy is basically the policy of the government where you're looking at the decisions the government takes around the expenditure and the taxation. Okay, so example, let's say the government has decided to increase the income tax in the country. Okay. So in that case, why is the government raising a tax rate? What are spendings of the government in terms of public sector? Yes, sir, comes within the ambit of the fiscal policy. Okay. So within the fiscal policy, there are two things: revenue and expenses. The source of revenue is taxation. जहाँ पे the government, Sitaraman madam, she will sit and decide what's the tax rate, then they roll it out, GST. ये सब जो tax revenue लगता है, ये सब will go into the revenue of the government. That is fiscal policy. Now, where does money get used? It's used in the expenditure of the government, where they are building bridges, metros, highways, infrastructure. So the allocation of the revenue earned by the government for the public betterment of the people is what comes within fiscal policy, right? Obviously, agar paisa nahi mile, if there's no revenue from tax, then there'll be no expenses that they can incur. Okay? So that's fiscal. Monetary policy is where the government is affecting the money supply and demand to ensure that there's stable growth. See, there needs to be a proper lending and borrowing money for investing, borrowing purposes. So this is achieved by the government. Basically, RBI looks after it through a proper monetary policy. Clear? Now, fiscal policy is a very important tool to GDP. And what is GDP? Gross domestic product. Okay. Now, it's very interesting. If the government spends more on building bridges, roadways, and so on, what will happen? There'll be more employment, more people will get income. There'll be more labor working, there'll be more income generated, and there'll be more demand. More demand leads to more production leads to more GDP. So the entire country's GDP goes up if government starts spending more money on public expenditure. Samjha? But for government to do that, they should make sure that they also have sufficient taxes revenue. Therefore, when you pay GST, income tax, remember, this is only for the betterment of our own people, where the money goes from the taxes to the pockets of the people in the form of wages, labor, income, and other sources. Clear? So that is called discretionary fiscal policy, where the government is using its own discretion to use the fiscal policy and spend money in order to influence the aggregate demand. The more the government spends, the more the aggregate demand will be influenced. Clear? Now, automatic stabilizers basically are where there are taxes, transfer payments that are made. Now, these are basically increasing the deficit during the times of recession and obviously decreasing expansion. When there's expansion, the GDP grows up, the deficit will go down. Similarly, if there's a recession, then the deficit will go up because the demand decreases and the supply will increase. So deficit will go up. So it's important for government to ensure that at the times of expansion and recession, they are trying to put in automatic stabilizers that will affect and improve the economy. Okay. Now, what tools does the government have in its fiscal policy? Okay, there are three tools: current spending, capital spending, and transfer payments. Current spending obviously is the spending of the government on a current basis, day to day. जो भी purchase goods are being bought and sold on a day-to-day basis, that's called current spending. Capital spending is जो government spends for a long-term purpose. अभी long-term में what spending? You put all in fish. Long-term is done in terms of infrastructure, roads. You can see the slide, right? Highways, bridges, All this is spending by the government on long term. So this is called the capex part of the government. Transfer payment is where the government is making payments to others, not for generating income or wealth, but simply just because they are a part of the system. Example, if I have people who are over 60, pension payments, provident fund payments, pension scheme, all this is paid to government by government to old people, not for doing any work. They don't generate any wealth income. They don't do any GDP work. But what is the government doing? They're making payments to them to enable them to increase or continue the consumption, the demand, and to make them independent, right? And to basically redistribute the wealth among the people. That's called transfer payments. Clear? Now, as a part of the fiscal revenue tool, we have direct taxes, indirect taxes. Direct tax, obviously, income tax on direct wealth and income. Indirect taxes which are levied indirectly in the form of, all of you know, GST. Obviously, VAT, because abhi bhi US mein VAT chalta hai, but in India it is GST. So indirect taxes. These two are the only sources of revenue for the government through the direct scheme. Clear? Now, there is a multiplier the government uses. Now, remember, the government says, I want to use my expenditure program to increase the aggregate demand and consumption. So what the government do? They'll decide, okay, how much will this impact the consumption? How much is the overall consumption impact? So the government will try and look at the propensity to consume. Okay, this is similar to elasticity, right? Basically. So the government will wonder, okay, if I increase the income, how much will the consumption increase? Okay, right. So we want marginal propensity consumption to consume. So what is marginal propensity to consume? Basically, oh, this one PDF. Yeah. Okay. So the word marginal propensity to consume, basically, this word is very important. I'll just highlight it also. So this basically means what is the change in consumption to change in income. Okay. Very important formula. Please learn that well. So basically, if I'm saying that every time the income of someone increases by, say, $10, so how much will he consume? Will he consume $15? Will he consume $5? Obviously, everyone's income will increase the consumption, right or wrong? If your income goes up tomorrow, then you'll consume more, hai na? But what is the rate of consumption? Some people are not bothering. They will consume irrespective. But some people are there who will say, nay, if my income goes up, I'll consume more. Now, the rate of change of consumption to the change in income is called marginal propensity to consume. What is my propensity to consume? Here, that is critical. So example, you can see a screen. If my income goes up by $1, I'll consume more 80 cents. That means it's 0.8. That's actually too high, right? But all of you will know what I mean, right? You'll probably consume more. You'll probably eat in more lavish food, lavish places. So this is where the government says that as a result of this multiplier, ye jo multiplier hai, right? This multiplier is what the government is interested in. They'll say, okay, if the multiplier is high, right? They'll say, okay, we will invest more and spend more. Correct? With that, we will be able to increase our output more because the multiplier is greater. So this is critical. Therefore, positive trait is that if the policy, the macro policy, it can improve the GDP and the consumption greater, there will be a better spending. Clear? So positive aspect is where it can have a better impact, but a negative aspect is that small decrease of the investments can bring down your entire activity together. So MPC is both positive and negative. Okay. And this is where it makes a big difference. Okay. Now, when the government goes and spends more money, like I told you, the money will go to whom? An increase in the government spending, right? It will go to whom? The labor class, the local people, the government, the income, the population. So the demand of the people increase because their income has gone up, right? So the aggregate demand will go up, and go up by how much? It'll go up by the change in the government spending. The change in the spending that the government is doing, and the change will trigger the multiplier. So we have to multiply that by the fiscal multiplier. So let's say fiscal multiplier is 0.8, right? Just to write here, if the multiplier is say 0.8 and government spending increased by, let's say, $10 million. So think carefully, spending $110 million multiplies 8. So what will happen? Aggregate demand will also increase. Right or wrong? By how much? 0.8 million. Sorry, by 8 million. By 8 million. Clear? 10 million, so 0.8, 8 million. So this is how interest rate is. Obviously, it's 0.7, it'll go up by 7 million and so on. Clear? Is that clear? So this is called the fiscal multiplier. You need some. Okay. Now we have the balanced budget multiplier. Now this is the multiplier for the balanced budget, where we're looking at how to balance the spending and the taxation. Now you do realize that it's important that the amount of tax is equal to spending. You should have spending and tax being equal, right? Now this multiplier will be positive if the marginal propensity to consume is less than 1. Then this will be positive. Okay. Now during recession, what happens in recession time? In recession, government will increase the spending. Think in recession mein there's not much work, right? The country are lull. So people don't have much spending, people don't have much income. So what will the government do? The government will say, okay, boss, I will increase my spending. With that, the people will get employment, the people will get income. And if the people have income, their demand will go up. And if the demand will go up, the economy will be strengthened. Clear? So during recession, the government spending will increase, the taxes will decrease, and with that, the people will have a greater propensity to consume because they have more income and less taxes. Their demand will go up. Got it? Let's come to expansion. Abhi expansion mein kya hoga? People are expanding, people have too much money to spend, right? And people have too much money to spend. They're willing to spend more money and invest. In this, the government will have to say, boss, you have too much money, let me take your money away, they'll increase the taxes. So the government will increase taxes and decrease their spending because the people have enough money. Understood? That's how it works. Clear? Obviously, if government increases the spending and the taxes also increase, then you'll have to look at the net impact. Because government spending goes up, people's income goes up. But if taxes goes up, people's income goes down. So we have to look at the balance effect of the two and find out what is the impact. And find out which one has a greater impact. Clear? Okay, this is critical. So you have to understand which is going to be likely to impact the consumers directly from an MPC and an MPS point of view. Okay, now look at an example for balanced budget multiplier. Suppose they're saying the government spending has gone up by $100. Abhi, let's say the multiplier is 2.5. So that means the spending of $100 goes up, the overall demand goes up by $250. Right? Obviously, because the multiplier is 2.5. Now the government will say, boss, agar itna badhiya, let me increase the taxes. So the government will increase taxes also by $100. Right? Now taxes will reduce the consumption only to the extent that people will spend money. So they'll say, okay, taxes gone up, but we'll reduce only to the extent. So the taxes will make the consumption fall down by the multiplier, correct? And therefore, the total fall will now come to not 250, it'll go to 200. So it went from 100 to 250 and 250 to 100 because of tax impact. Clear? Okay. And this is the net gain that you have to think of. what is the difference from one multiplier to another multiplier, and then you have to find out the overall answer. Yeah. So if you want to still look at example on this, you can say what is the overall MPC, and the amount will impact. The spending will always increase by the propensity to consume. Clear? So are we clear the concept of propensity to consume and the impact on the consumers demand? Okay. So there's a Ricardian equivalence theory. Okay. What does that say? Now this is interesting. What the Ricardian equivalence theory tells is that all the spending and all is not something that works. He's saying that if there is an increase in government spending, right? And obviously that's funded by issuing debt, right? Because the debt is issued, how the government get the money to spend? They'll have to get it by borrowing debt and all, right? So this will have no impact on the aggregate demand. Why? Because the people will view this as a future liability. They say, okay, now the income is going up. In the future, I have to probably pay a higher tax. And you know that income going up will increase your tax. So people might say, boss, I will have to pay more taxes, so I may want to spend less today. So therefore, he says that just because government spends more does not mean that automatically the people start demanding more. Now come to the other side, a decrease in taxes resulting from greater government borrowing. So if there's a, let's look at this criteria. So if there's a decrease in the government borrowing, right? From obviously in the taxes from more borrowing, government's borrowing more money, there's taxes decrease, then this will not necessarily increase consumption, because this only because the government's borrowing has potentially increased. Okay. So, so in the exam, just look out for this when they tell you what is Ricardian equivalence theory. It's a bit of a trade-off. It's trying to say that, okay, as per Ricardian law, there is no real impact on the aggregate demand. That's what Ricardian is trying to say. Ki by demand badhiya nahi, just because government spending went up, he's saying that demand will not really have any big impact. Clear? So please learn this logic and learn the concept behind the theory. Okay. Now the fiscal policy helps to stabilize the economy, right? How does it do that? Obviously, it can be automatic stabilization or it can be discretionary. Now, automatic, like the government saying, boss, I'll not do anything, I'll just sit there and watch. That is automatic. Jo hona hai, wohi hota hai. It will stabilize through no further actions. Discretionary is where the government does something at its own discretion, and based on the discretion, the change would take place. Clear? So, like I told you earlier, if it's discretionary, the government say, boss, tax rate ko vada do, get more money from people, and the stability will happen. Or decrease the tax rates, increase the purchasing power of the people, increase the aggregate demand. So that's discretionary, where everything is done in order to cause an increase in aggregate demand, because that depends on the change in the government spending and the multiplier. So jitna the multiplier, jitna the change, that much greater is the increase in the overall aggregate demand. Clear? That's why it's called discretionary, because it has a discretion and the impact is more direct. Clear? Any questions? Discretionary fiscal policy. Any questions? Yes. Limitation. Now, obviously, the discretionary fiscal policy has its own limitations and obstacles, right? One of the biggest limitations is this. There is a delay. There's a delay in the recognition and the impact. So it could be possible that I have adopted the fiscal policy, let's say, मैंने tax rate बढ़ा दिया, right? Obviously, the tax rate will come into effect after 3 months or 6 months. People will act on it after 1 year. So there's a big delay in the recognition part, action part, administrative action. So ये सब लेके the total impact on the economy is less direct. हाँ, obviously indirect taxes है, जैसे GST है वो सब, उससे थोड़ा और direct और fast है, because the impact is going to hit other consumption. Okay, so we just discussed on the biggest limitation of fiscal lags is the recognition delay. Okay, and the recognition goes to a delay in action, because remember, like, and I hope you guys know how the Income Tax Act, right? Sometimes the Income Tax Act will put the law, then the budget will go into approval, and then the approval takes time. So there are administrative and lawmaking delays, and this will impact the actual implementation. Clear? And this is the biggest limitation of fiscal policy. We'll come to what the limitation of monetary policy also are shortly, but this is how it goes. Impact delay. Now, impact also takes time because let's say the tax rate increase. It does not mean that people immediately start paying tax, right? Because everyone knows that the tax will be from the next year and the payment will happen only after some time. So that's called impact delay. Yeah? So if they ask you to understand, identify what are the three limitations of the fiscal policy, those are three lags: recognition lag, action lag, and impact lag. Okay. What are the obstacles? Obviously, the biggest obstacle is the misleading, statistics. Statistics basically is trying to show that the statistics that are being given to you, they are not accurate. They're not updated. Okay. There's another crowding out effect. Now learn this theory well. Crowding out effect means where you're trying to crowd out other people and other good things because of your policies. Example, government borrowings है, they'll crowd out more productive wala जो private borrowings है. Okay, because of the higher interest rate, they will crowd it out, and because they are able to penetrate a wider region. Okay, budget deficit है, तो उससे क्या होगा? Private investments also will probably be reduced. Correct? So these are all obstacles. Supply shortage are obstacles too. You have limits to fiscal deficit and so on, and multiple targets. Okay. Okay. Now the obstacles we mentioned the crowding effect. We have sometimes supply shortage also tends to be an obstacle. Limits to fiscal deficit. Sometimes the fiscal deficit may not be as high, and there will be some limitations to that. It may not be exceeding the amounts. Multiple targets. The multiple targets, the inability to address both unemployment and inflation together is a problem. Now, what often happens is we expect the fiscal policies to address all the issues, to address, let's say, unemployment, to address the inflation. Now, you cannot use fiscal policy to address both together. You can probably use it to address maybe the inflation problem, reduce the prices, control inflation, or the unemployment, but you can't address both of this. Okay? So, the other broad obstacles that you can look at. Crowding out, remember the word carefully, supply shortages, limits to a fiscal deficit. Clear? Now, a fiscal policy, this is a very important theory. A fiscal policy might be either expansionary or contractionary. Now, what's the meaning of this? Now, when I say expansionary, right, it means expand, right? It means that the economy is going up. Okay. Now, when does expansionary work? Understand one thing, what do you mean by surplus? Now, the word surplus means what? Surplus means more money, right? So, can you say when revenue exceeds cost? So, therefore, in a fiscal policy, there is a surplus when the government's tax revenue is greater than the government spending. Government is making more money. And same way, if the government's revenue is less than the government spending, that's called a deficit. Got it? So your surplus is more revenue, deficit less revenue. Similarly, remember a surplus would increase, right? If you have a contractionary policy. Other way around, they'll say, boss, agar surplus hai, if the surplus is going up, that means my fiscal policy is contractionary in nature. But if a deficit is going up, then that means the policy is expansionary in nature. So what do you understand from this basically? If there is a surplus increase, matlab policy contractionary, surplus decrease, policy expansionary, or contractionary policy will increase surplus. Learn this also. A contractionary policy will increase the surplus. Clear? An expansionary policy will affect your surplus. It will decrease your overall fiscal budget surplus. Clear? And this is also on the surplus front. Okay, any questions?
So, why does this happen?
Yeah, go on. What do you
Why
say?
does this happen? I'm
Why?
saying, why does this happen? Like, if the government has surplus, shouldn't the economy be increasing? So, shouldn't the policy be expansionary instead of contractionary?
Very good question. Very good question. Let me answer that. Now you tell me, what is a contractionary fiscal policy? Contractionary, matlab contract kar rahe, contract. In that case, let me give an option also. In a contractionary fiscal policy, the government will increase the tax or decrease the taxes. In a contractionary fiscal policy.
They'll decrease the taxes.
So if it is contracting, matlab the fiscal policy is reducing, is squeezing you, that means the tax is increasing. The contraction means it is contracting the economy, matlab लोगों का demand कम हो रहा है because it's contracting them. That means the tax has gone up, right? Or it means the government spending has gone down. That's why it's a contractionary policy. तो अगर tax has gone up, government has gone down, that means the government surplus has gone up, right? Other way around. What is expansionary policy? That means it's that policy where the revenue is going up, economy is booming, right? Sorry, the tax revenue potentially, sorry, is going down. I mean the spending is going up, spending is increasing, boom ho raha hai, people income is going up, taxes have also come down, boom boom karke expansion ho raha hai. That is expansion policy. But usme what's happening to government's budget? The surplus is going down or the deficit is going up. So when there's an expansion, it's good for the economy, but it's bad for the government's budget. Got it? Expansion is what? Spending more money, reducing taxes. So it is expansion means the tax has gone down, government spending has gone up. It means there's a deficit that is happening or a surplus that is going to happen. Yeah? Now are you clear? The girl who asked the question.
Yes, sir.
Yeah? So you got what is happening in a contraction and an expansion. Therefore, the surplus and deficit are decided. Okay? Okay, let's try some few questions quickly. Look at screen and answer questions, guys. Which of the following statements is most accurate? Most. Remember, it's most accurate. Chandru, WhatsApp. Is that correct? Does the direct taxes discourage alcohol consumption? Because indirect can be changed and if no use. Okay, good. Indirect taxes cannot be changed quickly. That's also correct. We know it can't be changed. So can you use it for, they are of no use? Are they of no use? That's incorrect, right? They are of use, right? Government capital spending decisions are slow to plan, implement, and execute, and hence are of the little use for short-term economic stabilization. What's the answer? Which is the most accurate? Most accurate. So is direct taxes useful for discouraging? No, people will bloody buy it. तूने tax rate बढ़ा दिया तो भी क्या फर्क पड़ा? GST बढ़ा तो भी they won't stop drinking, right? So that is not a discouragement for, obviously it may work in some way, but it's not most accurate, right? Second one we already agree is not the answer. So third one is most accurate because we are saying government spending are slow to plan because government, let's say government ने बोला metro बनाएंगे, we make a metro in Bihar, अरे time लगेगा यार plan implement करने का execute करने का, it will take time. Hence they are of little use. You can't say they are no use. They have some use to the economic this situation. Clear? Okay, try the next one, guys. Read the next question. Read the question, guys.
Sir, is it B?
B, okay. Others? Other girl? Because expansion, right? So we'll have to remember output when the economy is in which state? Near full, full, or unemployment. Now what is fiscal expansion? More spending and less taxes, correct? More spending, less taxes. So what's the answer? A, B, or C? So here, this is to use a fiscal multiplier. So what do you say? Answer? Here you can say fiscal multiplier. Now the answer is not directly B because the multiplier means the rate of change. The rate of change. The rate of change on the aggregate demand will happen when the economy is reacting to that answer. So here, if you're in full employment, you may not really bother too much, right, on your full employment. But it's only when you're at and you're in unemployment, then you can consider bothering. It's mostly when you are at unemployment or unemployment that it will make a difference. And therefore, the propensity to consume is much greater. Here. Okay, next one. So, third one, there's three more left afterwards. Which of following is most likely a reason to not use fiscal deficits as an expansionary tool? Now, I just told you, right? Fiscal can have expansionary deficit and a expansionary tool and a deficit tool. So, is fiscal deficit, think of using it. Do they crowd out private investment? Do they facilitate tax changes? Or do they stimulate employment when there's substantial unemployment? What's the answer? So yes, it's most likely going to stimulate employment because when there is expansionary spending, then there'll be more employment, less unemployment. In the term expansion, what they do is they try to make sure that distortions are reduced. Okay, what they'll do, they will change the taxes, the government spending, but they'll try to reduce distortions. Okay, that's very critical. So potentially the correct answer, okay, which of all is most likely reason to not use it as expansion. No one uses it as expansion tool because of the crowding out effect that is not there, okay, in terms of fiscal deficit. Now, you guys try the last three questions. Answer. Which of all is least accurate? Least. Discretionary aim at stabilizing automatic fiscal includes new plans for additional road building by government. This is automatic stabilizer and the context implement fiscal policy. The recognition lag is often referred to as driving while looking in the rearview mirror. Is that correct? Okay. Now the question is least accurate. So you find out which of these statements are true. Clear? Which statement is more true than the others? Are they aimed at stabilizing economy? Potentially yes, it's discretionary. So I'm doing it so I can stabilize the economy per se. Automatic includes new plans for additional road payment. Okay. Goes and in the context of implementing the fiscal policy recognition leg is often referred to as okay. Yeah. What's the answer from that?
B1.
B or C? So do you know what is driving while looking in the rearview mirror? Matlab tum drive karoge, you're looking like the rearview mirror, looking piche, right? So that is not what recognition lag is. That is more of the impact lag. So you also feel is B. Automatic fiscal stabilizers include new plans for additional road building by the government. Okay, that's an automatic stabilizer. जो उन्होंने किया. Okay, potentially. A government reduced spending by 50 million euro. MPC is 30%. याद रख, what is the amount of spending? Was a degree change in aggregate demand. Spending has fallen by 50 million. For the maths or not? So 50 million, MPC is 80%, correct? And what is the impact of 50 million reduced on the NPC? Was the overall impact? Now, you don't know what the multiplier is. Nahi pata. So find the multiplier. Now, multiplier is nothing but 1 upon, right, n minus the multiplier. Okay. So just I'll want to show the solution to you once. The fiscal minus 1 upon 1 minus MPC. But if there's a tax rate that's given to you in exam, please deduct the tax. So 1 upon 1 minus multiple consume, right? Remove the tax rate into 1 minus T. You will get the answer as minus 2.27, which is obviously what was put, right? And that amount is now put in the bank. Clear? Okay. So fiscal policy, right? Just to quickly recap for a minute, is all about the government's policies. Okay? Using a multiplier to decide कि government spending and tax revenue कितना होना चाहिए, which would be greater to lesser. Where should I try to fund my total amount? Clear? So that is my government spending. So government spending plus tax revenue. If this is more, the government will make sure there's more inflation. Yeah. So this is more, the revenue is potentially less, there will be expansion. And the government will be reappointed. They'll be, wow, that's a good policy. But if the revenue is less, is more, and spending is less, that's good for the economy broadly, but that's bad news for the people. Is that clear? And obviously the last one, crowding out effect. What is crowding out effect? Maybe of concern. Okay. The standard national is most likely to be a concern of policy meters. Okay. Matters if crowding effect occurs. Clear? Okay. So that is entirely your fiscal policy in mind. Yeah, fiscal policy. So we discussed all the aspects of tax revenue. Now we'll move on to monetary policy. Yeah. Now monetary policy before we start is just all about the use of money to decide the demand, supply, and the movement of money in the economy. That's called your monetary policy. Okay. Who does it? RBI. Okay. So yeah. Then let's take a quick break and then I'll complete monetary policy in one shot as you do it from start to finish. But in the meantime, please read out the fiscal policy, understand what exactly fiscal policy is. Monetary policy looks at the money side of things among the banks, interbanks, all that. Yeah, monetary policy is based on the changes in the money angle. अगर money का demand बढ़ा या supply बढ़ा, right? Because of like RBI ने बोला अभी interest rate को कम कर दे, तो obviously people demand more loans, right? People might probably invest less in bank because जैसे अभी छोड़ना gold silver में ज़्यादा पैसा है, why to invest in shares? So you have to think of certain specific people, okay, for the purpose of the monetary policy. Right, so let's continue with the monetary policy. You guys can see the screen, right? Yeah. So quickly, what the learning objectives of the monetary policy is to understand, discussing the role objectives. So basically in the monetary policy is based on the banks, what the banks have, what are the overall objectives, right? Now here it is the central banks and also the central, which is the RBI, right? And you have the other banks that are supporting the RBI. What are the tools? What are tools that these banks have in order to ensure that there's a proper flow of money, right, in terms of monetary policy and so on? And what's the relationship between this policy and the growth of the country, between this policy and inflation rate, between this policy and the interest rate? So you have to understand how the policy will affect the inflation, interest rate, exchange rate. In the dollar, Indian rupee is also impacted by the policy of the RBI. So we'll understand those aspects, obviously, and we look at what are the quality of effective central banks, right? Use of the inflation. We look at how inflation, interest rate, exchange rate, and all are used in both expansionary policy and contractionary policy. Okay. And then we look at the limitations of the monetary policy per se. And we have to finally conclude with the interrelationship among the monetary policy and the fiscal policy. Okay. So you'll try to see the interplay between these two policies and how they impact one another. Clear? Now, what is the monetary policy? The policy of the banks, which is intended to control the money quantity in the economy. So obviously in India, see, we are not a country which will just print money, right? Example, some Zimbabwe, other countries, they tend to print money if the money is short. But we can't do it because that'll lead to inflation. Money is controlled. The quantity of money in circulation is always controlled by the central banks. And this policy activities which are used to control the money is referred to as monetary policy. Clear? Now, why do we have the monetary policy? What's the objective? Very important. Ensure price stability. Okay. Basically, the RBI jobs make sure that prices do not spiral out of proportion. Clear? That stability is required. And that stability, right, leading to further a proper stable inflation is the main objective. So the objective is not to say and maintain a dollar India rupee rate. No, it's not to maintain some interest rate. It is not there to maintain maybe employment, but main objective is stability in prices. Apart from that, other objectives could be maintaining employment, supporting the growth, output, confidence system. All these are the other objectives which also have to be met. Clear? So we have a main objective and we have other objectives. Clear? Now, what is the role of the central bank? Okay, and objective. Now, while we're discussing this, please remember in India, the central bank is RBI. Correct? पंकज आपका unmute पे in India the central bank is RBI. So the RBI has certain rules and objectives which it has to comply with as a part of its banking function. What are those rules? Now let's quickly understand the key central role of the RBI. Supplier of currency. What's the meaning of that? So basically the RBI is supposed to ensure that there is sufficient supply of Indian rupee currency. Same way in US, the central bank will make sure that there's certain sufficient supply of dollars so that people can buy and sell goods, right? So that's called supply of currency. RBI is also a banker to government. Matlab, the RBI will be acting as a banker to the government of the country, giving them money when needed, taking money, funding the operations. This is called banker to the government. RBI will also act as a banker to other banks. Let's say Kotak needs money, funding, overnight funding, right? Or SBI needs money. The RBI will act as a banker to the other banks as well. Okay. RBI is the regulator of the banking and payment system. Every payment system, every payment app done through a bank system is regulated and monitored by the RBI. Lender of the last resort. Very interesting name. Last resort, matlab what? No one's left. Everyone has put their hands up. If suppose any bank has a shortage of funds, it will have to go and borrow money from someone. Let's say Kotak has a problem. Let's say ask HDFC Bank, Bank of Baroda, right? Or Allahabad Bank. They'll ask. But suppose none of these banks are willing to lend money, then the RBI is referred to as the lender of the last resort. मतलब सबसे आखिर में RBI तुझे बचाएगा. That's called the lender of the last resort. Clear? The central bank is also the owner of the entire gold and forex reserves of the country. तो पूरा जो देश का गोल्ड और फॉरेन एक्सचेंज है वो सब RBI के हाथ में. So they are owning it. Obviously they use it to make sure that there's a proper management and there's no fluctuation in the rates. Clear? So what do I call this? Owner of the country's gold and the forex reserves. Clear? Now, obviously, they're also responsible for issuing, monitoring, regulating the monetary policy of the country. They are responsible and they'll do that. Clear? That is their job. And as they do that, they're able to make sure that it is enacted and is developing the country's GDP. Clear? Now, what are the objectives? Okay, now you already learned the main objective. The main objective is what? To control price inflation. Clear? Main objective. Apart from that, they also have to ensure that the currency is stable, the forex is stable. There's no, it's not suddenly gone up and down too much. There's a proper employment. The growth is stable. It's positive, right? The interest rate is not going too up and down. Okay, it's in line with the requirement. Clear? So these are the other objectives. So when you look at objectives, the first one is price inflation ko control karo. And the second or the other objectives are other things like currency, employment, stable growth, and so on. Okay. Now, using this in mind, let's think of certain other factors. What do you understand by the word inflation? Now, inflation obviously is nothing but a rise in prices where the goods have become more costly, right? Or other way around. Earlier, you could buy maybe, one item with 10 rupees. Now you can't buy the same item with 10 rupees. You probably need to buy the same item with 15 rupees. So your purchasing power is reduced, right? You're not able to demand the same number of units for the same price. That is called inflation. Okay. Now, if inflation is not expected, मतलब surprise, अरे anticipate ही नहीं किया. It was never expected. It's a surprise to the people. Then I call that as unanticipated inflation. Inflation which is not anticipated. But if suppose the inflation is something, oh, people say, अच्छा ठीक है, inflation expect हो रहा है, I think prices are going to go up. People expected that. Then, if that inflation is widely anticipated, it is called as anticipated inflation. So whenever inflation happens, there's always a study and public will want to know whether the inflation was a part of anticipated or unanticipated. Clear? Now, obviously, sometimes you'll anticipate it's called as expected inflation. Why did they come up to? Now, these are peculiar terms you'll hear. Okay, you'll know about expected inflation. Now, it may rise due to two things: menu cost and shoe leather cost. Now, little weird terms, funny concepts. It's not directly in the book also, but also earlier. Menu cost का मतलब क्या है? Basically, menu cost means the cost of changing the menu card. That's where the name came from. Right? So suppose I have a menu card, उसमें the prices are certain amount और मुझे inflation से I want to increase the prices of those menu dishes. Right? So I'll have to put a new menu card, right? And this new one will have a new price. So the price will go up. And this price going up because of menu cost changing, because new menu items, is called as expected inflation rise. Clear? Apart from that, you have shoe leather cost. What is shoe leather cost? Shoe leather cost means, now this is also a little tricky, is basically saying that the amount that you'll incur towards the wear and tear of your shoe, okay, if you were to apply the amount incurred towards the wear and tear of your shoe leather, right, to go to a bank to withdraw money, that is called as shoe leather cost. Clear? So we have menu cost and shoe leather cost. So what they're saying is the inflation is normally expected to rise on account of two factors: menu cost and shoe leather cost. Now you have unanticipated inflation. What is unanticipated? Now this is where inflation was never anticipated. It just occurred, right? And this inflation that's not anticipated may cause an inequitable transfer of wealth between borrowers and lenders. So it may show that, there's a difference in the amount of wealth, and that wealth is not being done equitably. So that's called unanticipated inflation, right? It may lead to rise in the risk premium in borrowing rates. If inflation suddenly goes up, then the borrowing rate also will go because the price becomes more costly. So the risk premium might go up, right? Okay. And that's also leading to inflation, unanticipated. Obviously, the market price, see, many times the inflation price has gone up. The market prices may be overstated because of the unanticipated inflation. Okay. So obviously, people try to protect themselves from inflation. They'll try to make sure they put efforts. They'll try to make sure that they build up income, capital, and they make sure that inflation is not going to impact them. Correct? And that's where the inflation makes a big difference. Okay?
So,
Yeah, go on.
so
Tell me, I can't hear you. What?
anticipated the COVID-19 crisis, was that an anticipated or unanticipated inflation?
Oh, yeah, it's expected. So, वही बोला ना, we explain that this anticipated means when the inflation is something that was already expected by the economy. They felt, मतलब अगर let's say prices are going up, let's say income has gone up, taxes have gone down, so you feel people have more money to spend. So obviously the aggregate demand will go up. अगर demand बढ़ रहा है, right? If the demand is going up, then that means the prices are bound to go up. है ना? जैसे अभी हाउस मार्केट है, the demand is going up, so there's more prices going up and up. Why? But because the people's income is going up. So people know that because income going up, demand is going up, people know that the prices are going to go up. That's called anticipated. Jitna anticipated hai, utna hua, to it's called anticipated. But if the prices go up beyond expectation, beyond anticipation, then you will call that as unanticipated.
Okay, sir.
Clear? It was never anticipated to happen. It was not expected to happen. So that's called unanticipated inflation. Now, this is a very important slide. Basically, we are saying that by RBI ke paas ye sab objectives hai, but what are tools? What are tools that will allow the RBI to actually achieve the goals? What are those tools? The biggest tool, the most important tool is the policy rate. RBI will look at the interest rate and keep changing it based on the policy. Now, obviously, abhi recently again, since the RBI reduced the interest rate, RBI say, boss, interest rate ke saath main increase karunga. Let's say there's not much money in the economy. People are investing. So RBI say, ठीक है, interest rate kam kar do. So if the interest rate goes down, then more people borrow, but the money is cheap. And when you borrow money, they'll spend the money or they'll invest the money. So there'll be more savings, more investments, more demand. Right? Correct? So every time you have to make sure you look at these aspects. Okay? Interest rate, which is also called the policy rate, will always directly impact the people. Okay? Second, reserve requirement. Now remember, all these three policy tools are helping you to change the quantity of money in the economy. Correct? अगर मैंने इंटरेस्ट रेट कम कर दे तो इकोनॉमी पैसा ज्यादा आ जाएगा बिकॉज बोरिंग बढ़ रहे हैं. अगर मैंने इंटरेस्ट रेट बढ़ा दिया तो शायद इकोनॉमी पैसा वापस आ जाएगा बिकॉज पीपल आर गोइंग टू इन्वेस्ट. Clear? So that's how the tool goes. Now, what is reserve requirement? Reserve requirement, as the name suggests, is nothing but the deposit that the banks have to retain cash. So, agar bank ka deposits, you know, a deposit, current account deposits, let's say they're 100, 200 crores. Now, the bank cannot just put the amount 200 crores and, expect to, loan it. Now, what will the bank do? It'll take 200 crores, put as deposit and lend it. The bank cannot lend the entire money. The bank will lend only, let's say 90%. Okay. The bank is lending 90% of 200 crores because the bank is bound to keep 10% in the form of MRR. Clear? And this MRR, margin reserve requirement, is something that the banks will always follow. Clear? Okay. So now you understand that if I reduce the MRR, then banks can lend more money because reserve requirement come ho gaya. So zyada paisa investors. Clear? So MRR is a very important tool. Now the third tool, okay, is called open market operations. Very interesting. So open market is nothing but when you go to the open market and you buy and sell what you feel is cheap or what is costly, you can buy and sell it in the open market. Okay. So if FED, Fed also buy and sell security in the open market, they'll buy it, sell it. And this buy and sell security happens in the open market operations. Clear? Yeah. The most commonly used tool by the FED, Fed in the US is the open market operations. Any questions? Okay. So quick recap, policy rate, MRR, open market operation. Now open market kya hota hai na? Basically, you know how the treasury bills are raised, right? So the government will say, boss, if there's more money in the economy, it will say, boss, give me the money, I'll give you a government security, like a T-bill, RBI bond or whatever. So that will allow the people's excess money to be collected by the government. And then they'll decide what to do with the money, right? And they'll pay it back to them after 5 years. But at least they're making sure that the excess money in the country is not ending up in inflation. Clear? Okay. So this is the three tools that are very important. Now when you come to equilibrium, now if you remember I taught you equilibrium in demand and supply chapter, right? Now understand, when it comes to money, right? Now money also has a fixed supply. Ye nahi ki money can be printed. Money supply is fixed, right? Fixed. You can't increase it. The money demand is what? Money demand is a downward sloping curve where interest rate will decide the money demand. If the interest rate is high, the demand is low. Interest rate is low, high, low. Okay. So the interest rate is inversely proportional. Clear? So therefore you'll see on this curve, I'm looking at interest rate falling down, demand for money going up, right? But there's a point where the demand for money will equal the supply for money. And this point is called the equilibrium point. Because if I go to this point, then there is excess supply of money. Right or wrong? यहाँ पे demand इतना ही है, but supply इतना है. तो ये पूरा supply ज़्यादा है. Just thinking. हाँ, have I taught you demand supply? The demand supply curve, I taught you the equilibrium point, and I also taught you same logic that if the demand is slightly higher and above, that will be the shortage of demand, shortage of supply. Same logic will apply here also, where on this point there's a what? Shortage of demand and more supply. On this point there's excess demand and there's supply. Yeah, clear? That's the same thing explained here. And here is where RBI will fall into play and say, boss, hang on. Why is your supply so high? So they'll take the excess supply and buy. Say, boss, I don't care. I need to buy it. Okay. Same way, if there's excess demand, okay. If there's excess demand, then the excess demand will result in sale of securities. Yeah. So RBI is very clear. There should be equilibrium. If the equilibrium is not there, they'll enter the market, they'll do open market operations, and they'll buy and sell as the market changes. Clear, guys? Any questions on this?
No, sir.
Okay, very good. I hope you answered why. Okay, now you tell me one question. Why is this a flat line?
Because the money supply is constant. RBI doesn't change the money supply at any given time.
Okay. And it's only that, it's all about the fact that money can't be printed, and no matter what the interest rate is, I will be able to give only so much. Interest rate may become 5%, 50% also. Money supply itna hi rahega. That is called money supply. Clear?
Yes, sir.
Okay? Clear? Now, and you know how equilibrium is happening. Now let's go to the concept of money, monetary.
Sorry, just
Now
about
go
the
on.
previous concept, right? About the money supply.
Yeah,
You know, some countries when they print more money, etc.
correct.
Uh,
Yeah, they do.
yeah. So that is not money supply, is it?
So that's what. So there are some countries, but no country like USA, India, France, Australia, Singapore, UK, they don't do that. But in short, money supply can never be printing money and increase supply. That can't happen. Money supply means that the supply of money. So you can't just go and, or like air is unlimited, right? Or say some, but money itself is a flat line because every country, every bank of every country will maintain the same supply of money no matter what. Okay. So money supply in all the developed countries is always fixed no matter what. That is a norm. That's a rule. Okay. Even USA does not print money. Okay. And if they do have it, they'll do it based on the gold. You know, they'll have the gold chip and other stuff. But money supply is very clear.
Okay, thanks, sir.
Okay. So you all know money supply is now straight line. It's a fixed line. It's limited in demand. It's supply. Money demand is a falling line, which shows that you'll demand more money at a higher interest rate, right? And these changes are referred to as the monetary transition mechanism. We call it MTM, where we say that changes in the policy rate will influence the price level and the inflation level. It will influence, right? Answer how. In the short run, obviously, it'll affect the company economy through short-term interest rates. Clear? So let's say, and this is what you have seen always, RBI will come and say, boss, the rate has fallen from whatever to whatever. Immediately, within the next four weeks, everyone gets a letter saying that the rate has fallen by 25 basis points. Clear? And the rate will affect directly the short-term interest rates in the economy. Everyone who now comes to bank will get that much less interest. Got it? Surely, based on the sets. Now, let's come to the second one, asset prices. If there is a change in the interest rate, even asset prices change. How? Simple. It is affecting the underlying asset on which the demand or supply is increasing or decreasing, right? That is called asset price change. Okay, so sometimes what happens is maybe, there's a fall in interest rate, so more people will borrow money, and more people borrow money for what? Home loans. So suddenly the home loans price might go up because there's suddenly a large demand for home loans, and this demand will push up the price of home loans. So real estate prices will increase. Clear? Okay. Exchange rates, very interesting. Exchange rates are basically the dollar Indian rupee exchange rate. Now you've noticed, right, how the exchange rate has been changing, moving, fluctuating widely. Why is that happening? Why? It could be because the currency is more safer, it's more attractive to buy and to invest. And obviously, the currency need not invest in India, right? It's for the US economy. So when your exchange rates, it's nothing but a function of the exchange rate amount that's been agreed upon. Yeah. Lastly, expectations, right? So expectations are also based on the people. They'll expect a certain amount or a certain decision, and based on that, the rate would potentially change. Clear? Now, let's look at the MTM. I already explained to you. You can read this further. High interest rate will affect the bank's lending rate, right or wrong? And the lending goes up, and then it'll also affect the borrowing business intention. It'll also affect the other rates. Okay. Expectations, we already know what expectations are. And trust me, today's market expectations are bigger. It makes them, it's a bigger, a judgmental aspect. Okay. So your expectation of building you can say expectation for future growth, both consumers and firms cut expenditure. Yeah. Exchange rate obviously is very simple. Everyone knows the Indian rupee, the dollar, the pound. Exchange rate is always going to change. If you have foreign exchange from other countries, what is exchange rate? So based on that, the exchange will always be changing. If the demand for Indian rupee goes up, then the Indian rupee will move up. Yeah. So this is how the exchange would potentially be tackled. Okay. Now, so how will you compare monetary policy? By using economic growth, inflation, interest, and other expenses.
So,
Yeah. Go on.
a few minutes ago you said if the demand for the rupee goes up, then the exchange rate will go down.
If the demand for the rupee will go up, no, then the exchange will go up. No, because the rupee is being demanded, so more people will demand rupee. So exchange will go up only. Ulta. Yeah. Go on.
So if we stop if we limit the imports, if we limit the imports, what we're importing from other countries, then
Yeah.
won't that increase the demand for the rupee because the rupee will flow out less in other countries? So,
Right. Yeah. But this is an intercompany adjustment, so it might be taken care of. Yeah.
so will that be, is that viable to do? Because if that happens, then all the countries can just do that to increase their exchange rates.
So what happens is it's not viable. And in order to do that, it should have an impact also, no? The impact is not always going to happen. So example, you give me an example, what you want to say, and I'll tell you what doesn't happen. You give me any event, I'll explain to you. Give me an event.
So suppose we are importing some commodity, like let's say someone is importing cars from Japan, let's say.
Okay.
So if they limit the imports, if they manufacture the cars here itself, the
Ah,
currency will
see,
flow in the country itself.
correct. So that has nothing to do with change of foreign exchange currency. What you're saying is a very good thing, and that's India already doing. After Modi came, they decided that we'll do Made India project. You know, Make India, right? So everyone's doing same Make India, Make India. In the Indians, people are doing Make India. They're getting much more revenue right now. So yes, that's a definitely a good answer. That's already being implemented by now.
Okay, okay.
Yeah, that's correct. And by doing that, they're protecting the Indian producers also. They're protecting them, right? That's more critical.
So, but even after that, the dollar price has been increasing. Like last year, I think it was
No,
around
no,
80,
that's
and
true. So the dollar is not around 75, it became 90. But the point is, the dollar price not increasing because the Indian rupee is decreasing. You can't see the Indian rupee is depreciating, or that means the everyone gone for a toss. So you have to look at the dollar price and look at how the movement has varied.
okay.
Okay. And don't forget, this is not always foolproof. You can say, okay, I'll do Make India, I'll make people not import. ये सब बोलने की काम है, होता नहीं है, बहुत मुश्किल है. You can't ban people from not doing Amazon. People are on Amazon full day. No one will want to stop buying on Amazon. Okay. So that's
Yes.
very critical. ठीक है? Okay. So we have monetary transfer mechanism where basically we say that whatever the policy for the purpose of monetary transmission, that policy should be covered. Okay. So basically, the effect of a charge to a more recessionary movement, okay, will make a difference. Now, remember, what is now your answer? Recessionary and expansionary. क्या फर्क है? Now remember, recessionary means मैं पूरा economic recession contract करा रहा हूँ. Expansionary means I'm expanding. Learn that. So you can decide based on the time factor. Okay, and potentially what happens if a central bank wants to stimulate purchases, right? So potentially, okay, a central bank wants to stimulate the economy will purchase securities. Now, what does that mean? Let's say I want more money in the economy. Correct? I want to stimulate. So what the banks may come and do? They may try and purchase securities and give money. So more money will be in the economy, there'll be more circulation and there'll be more investment. Long-term growth bhi rahega. So stimulating economy can happen through purchasing securities. Now let's say there's too much money in the economy. So what they'll do? They will sell the securities. Because when I sell the securities, I'm taking back my money. So the government plays a good role in selling and buying securities as and when to make sure that they have a good hand. Clear? Okay. Any questions?
No, sir.
Okay, sure. And same to others, lower interest rates. See, now if they discuss only interest rates in detail, now, then obviously it will have an impact across. I told you in the earlier part of the lecture also, if I have a low interest rate, what will happen? My interest rates will go down, right? And therefore people will want to probably borrow more money. It may also increase the demand for money because people are saying, boss, chalo yaar, paisa sasta hai, so jaake invest in businesses, right? And this low rate, very important, will lead to a currency depreciation because our money is cheaper, right? Interest rate कम हो गया. So the other countries are, India का इतना सस्ता है, चलो खरीदते हैं. Indian money will also become a part of the regime. Okay? And obviously the increase will result in all of this. So this is a cycle I wanted to understand. Interest rate goes down, everything goes up. Borrowing goes up, GDP goes up, employment goes up, currency depreciate होता है, उससे मेरा export बढ़ेगा. So everything essentially will increase. If your rates effectively go. That's why if you see a interest rate fall by RBI is seen as a good move because finally देश का ही भला हो रहा है, right? Correct? Now here we have two, expansionary and contractionary. Again you already know this. An expansionary policy is what? Just say expand हो रहा है money supply. The money supply is expanding in the economy. Clear? This is called expansionary policy. Now, a contractionary policy on the hand, a contractionary policy on the other hand is something where the inflation is trying to be reduced, right? अभी expansion क्या होगा? Inflation बढ़ने वाला है. But अगर ये कम करना है तो मैं contractionary policy use करूँगा. Contractionary policy will help to reduce the overall inflation, right? Now, central rate of interest, what is it? Obviously, whatever interest they take, it's a part of your commission. Okay, so they put it up there, and the motive also is quite contradictory, obviously. So the first effect of a successful monetary policy is making sure that the inflation is successfully targeted, right? So it is important that the banks are working independently. They cannot work with the pressure or interference of the parties. So central bank like RBI must be free from all political pressure. They cannot be like, okay, BJP says something, Congress says. They have to work independently because their objective is the price, stability, employment. So they cannot sit and dance to demands from politicians and others. Why? Because politicians might look for their own interest or they may look for short term. But the bank should look at long term. Now remember, independence so hai, but independence should be relative. See, normally independence can't be absolute because the banks are only set up by the leaders and the heads of the bank are also by the leaders. So you can't really claim that you're independent, but there should be some relative independence. Like the head of RBI cannot be saying, okay, I'm going to report to the head of the country, the prime minister, so therefore I will do what he says. No. Okay, so in that case, they're independence. Now, what's the independence? The independence is operational, do what you want, make sure you're achieving objectives. And the independence also in terms of the target, what target I have to achieve. The target level is independence, and you have to have the independence in that regard. Okay. Now, the European Central Bank will enjoy both. Okay. Most of the central banks will have mostly operational independence, but the European Central Bank in Europe will have both operational and target independence. Okay. And other central banks should ideally have at least operational, because operational is where they are likely to do things as a part of their daily operations. Clear? That is independence. Credibility. The banks must consistently act in line with what they set out. They cannot be like, they have to make sure that they're credible. What they said they'll do should get done, right? And that is credibility. If the bank does not control the inflation, debts are going high, then they lack credibility. Then you never know what will happen. So that credibility is very important. Okay. A credible central bank makes its targets self-reinforcing. Clear? So targets are met when the credibility is high. Transparency. There should be a lot of transparency among the banks, making sure that they are achieving their targets. That is critical and they cannot go away from that goal. Okay. So main targets that are supposed to be achieved, how are they really completed? Let's look at the way they do it. Now, euro interest rates are always something the banks are trying to maintain, right? So what banks say, they say, let's keep interest rates in a certain band. Let's say they say between 5 and 6%. Yeah, 6 and 7%. If interest rates are moving above the band, right? Interest rates are moving up. Matlab demand बढ़ रहा है. Demand is going up. If the rate is going up, what does that mean? It means demand is going up. So what they'll try and do? They'll try to increase the supply. Got it? So if the rate is above the band, then the demand is going up. Supply will be increased to match the demand. If the rate goes below the band, that means demand has gone down. They'll say, ठीक है यार, एक काम कर, supply भी थोड़ा कम कर देंगे. Supply also will go. Yeah, this is interest rate. Inflation targeting. Inflation targeting कैसे करें? They look at what is inflation, and obviously today most banks are trying to control inflation. Inflation is something which is a critical concept based on the price demand, right? So inflation can be controlled directly. You have to ensure that you look at what is the neutral interest rate, which is nothing but the growth rate of the economy and so on, right? Now, if the policy rate is more, Ali told this earlier, is more than the neutral rate, policy rate is higher. That means they are trying to contract the economy because rate is too high. So people can't borrow, people can't invest. So the rate is very high, then there's contractionary because the borrowings are reduced. But if it is expansionary, that means there is cheaper rate and therefore the borrowings are increased, investment is going up and so on. That's called expansionary. Clear? Obviously, don't forget, most banks are normally aiming for a 2% inflation because that is the range that they are able to manage. Okay. So normally banks are looking at long-term inflation target and that's critical. Okay. So inflation, interest rate, exchange targeting, these are all something that targets are set by the central bank of the country. Clear? Exchange rate targeting. Now, we spoke of interest rate, inflation, or exchange rate. Now, you all know RBI also is very interested in making sure that the exchange rate is being managed, right? There's certain target giving and the exchange rate is based on that used to ensure that the currency of the country is not impacted. So you already know some countries have a fixed exchange rate, correct? Example, Dubai, right? AED, Oman. These all are linked to the dollar. Yeah. So, Dubai, the exchange is pegged to a dollar, which means they are always going to have the same rate with a dollar 3.67. If the dollar goes up, their rate also will go up. So these countries have a fixed exchange rate, correct? Now, other countries which don't have fixed exchange rate, they will have to react. So let's say the domestic currency weakens, domestic currency falls, depreciates. So all the central bank do, they will buy their own currencies. They'll try to say, yeah, currency is falling. Let me buy more currency and let me increase the demand and bring the value back to normal. So they'll buy their own currencies using the forex reserves. Clear? But obviously, it's important to make sure that the money supply will react. Okay. Now, if the domestic currency strengthens, if it goes higher, then instead of buying, they'll say, let's sell the currency. Right? The more the currency sells, the money supply in the market will fall because there's more money and automatically the value of the currency will depreciate. So that's coming back to equilibrium. Yep. This method can create obviously large swings in the money supply. So these methods are normally there to react, but they can obviously end up in having a big swing. Okay. And that really depends. Okay, only works as long as country has enough for example. Obviously, you can't sit and buy exchange for exchange sell if you don't have enough foreign exchange reserves. So this will work only where the country claims that it has enough foreign exchange reserves owning to another country. Yeah. So how do central banks influence interest rate? Now this is a similar concept. I told you money supply is fixed, interest rate is demand so much, interest rate goes on, demand increases. So normally you'll say, boss, ye hai mera equilibrium, right? Now what becomes interesting is this. Let's say the supply in the short run, the supply for money increases. Largely increases. The supply increases, the demand is same. Then what will happen? If the supply goes up and the demand is the same, then what will happen? Then the interest rate will also change. Clear? Okay. So obviously they'll change the interest rate. See, because remember, the goal is to make sure that the interest rate potentially is covered, right? So they'll use the same policy tools. They'll say, okay, let's use the interest rate, let's do open market operations. And there, so it's not so difficult, please learn how to apply it. Okay, it's fairly easy question to pick up. Clear? So when you pick up this topic on the board, please understand the concept also. Okay. So central government wants to increase. Now tell me, if they want to increase the interest rate, what will they do? Will they sell or will they buy securities? So obviously, if they want to increase the interest rate, they're trying to make sure that there is potentially, the money. So when they sell securities, they're saying, okay, ye raha mein security, take it, and they'll take the money from you. Clear? Okay, so remember again, contractionary, expansionary, they are concepts or terms which are helpful in this demand. Now, monetary policy also on its own, like fiscal policy, has a limitation. The biggest limitation is it is obviously different from short term, long term, and may move differently. It depends on many factors, inflation, etc., and so on, right? If the people expect a lower inflation, then obviously the long term rates will fall because they're expecting a lower inflation. So in the long run, it will fall. If they expect high inflation, then the long run, this might be fall, right? Okay, and that's critical for us to understand. Expectation of people is critical here. Because always the market will react to expectations, right? So if people expect low inflation, then they will look at the inflation being low. But if the people expect high inflation, will react accordingly, then the long-term rates might rise in the future. Yeah. Equity type decisions harder. Many banks do not reserve. And what is quantitative? This is very important. Quantitative easing. Quantitative easing means when the central bank says, boss, there's not much enough money in the market, or people are having short-term money, the central bank will go, there's not enough money, they will enter market and they'll ease the money in the market by trying to push down security. So either they'll say, come on, give me money, give me a security, I'll pay you money, or they'll say, take the securities and you can issue money. So they'll try to buy or sell the long-term securities in the this economy. Clear? So here the relation, so this is very critical now. Understand this very carefully. Relationship between fiscal and monetary. Understand carefully. Expansionary policy means what? Expansionary monetary means expansionary, there's more money supply, and fiscal means there is more government spending. So what will happen? If both are expansionary, both will increase. Highly expansionary. Sectors will grow, price will public will the expenditure and the income is growing, and money supply will also improve, right? But if monetary is high, but fiscal is contractionary, right? Fiscal contraction, मतलब उन्होंने interest rate let's say बढ़ा दिया, tax rate को थोड़ा increase कर दिया, and so on. Then what they'll do is it will lower the interest rates, right? Increases, and this increases the price sector. Okay, there will be a contractionary fiscal policy impact on the public sector in, spending. Clear? So learn the grid. If both are expansionary, this is highly expansionary. But if expansionary, monetary, and fiscal contractionary, then what will happen is because of fiscal policy contractionary, there is a lower interest rate, increases power price sector. And the contraction also reduces public sector. So price sector public sector दोनों में reduce हो जाएगा. If the policy is contractionary for monetary but fiscal makes expansionary, that means there is more fiscal, there is more increase in government spending and interest, and therefore there is more proportion of national income. Clear? Because fiscal policy should be increased for more spending interest rate, which is going to government. Clear? And decreasing output and increasing output interest rates is similar, both in public sector included. Okay? If both are contracting, right? If both are contracting, then obviously the entire economy will be contracting. Interest rates will be going very high. People not able to borrow money. People don't want to even spend money. Even the aggregate demand will go down. And obviously everything will sort of go into a recession type situation. Clear? Okay. So quickly understand this. The final slide. What is the interplay of fiscal and monetary policy? Okay. If monetary policy is tight and fiscal policy is tight, both are tight. That means interest rate is high, right? That's why they're not getting money. पैसा नहीं आ रहा है. Interest rate is high. Obviously, पैसा नहीं आ रहा. So aggregate demand is low. Demand is low. Output is low. Spending is low. Everyone now will get spend much money because interest rates are too high. So people are able to spend money. So everything is less. On the other hand, if everything is easy, then interest rate is low. Everything else is high. Got it? Simple. Here I do very easy part. If high hai, to boss paisa kam hai. If low hai, then there's more money, so they'll go for high. Now let's come for one low, one high. Monetary policy is tight, but fiscal policy is very good. So very good. Fiscal policy is very good. Now remember, monetary policy is tight, interest rates are high. Fiscal policy is good, output is also high. Clear? And obviously, apart from that, private public spending, sector spending would change. But remember, it's about making sure that interest rates and output are critical. Okay. Now, other way around. Monetary policy easy, expansionary, but if fiscal policy is tight. Obviously, in that case, you will not know the output is, but you surely know that interest rates will be much lower. Okay, then okay, and public spending price may vice versa. So this grid helps you to understand the effect of fiscal and monetary policy, where one is expansionary, one is contractionary. Both are expansionary or both are contractionary. Clear? This is very important for you to understand and learn it from this aspect. Okay. So with that, we now come to the fiscal policy, the monetary policy, and the like. Okay. Let's quickly look at the quiz questions. Okay. First one. Monetary policy is least likely to include what? Is monetary policy anything to do with inflation rate target? Yes. Official rate? Yes. Interest rate? Official? Yes. But it is not likely to do a transfer payment. Transfer payment program comes in the fiscal policy, right or wrong? So answer is least likely. So the answer is transfer payment. Okay. Which are most accurate statement regarding central banks and monetary policy? Is about price stability? Looks like do they work through a company by 4 independent channels? Maybe. Company may move inversely to official interest rates. Do they do that? I don't think so. Do they move officially inversely or they move in the same direction? In the same direction, so not inversely, right? Monetary policies work through the economy via 4 independent challenges. Okay. Yeah. So what's the answer? Everyone knows the monetary policy is there to maintain price stability. Right? We've been discussing this one, start that the primary objective of monetary policy, first objective, price stability. Okay. An increase in the central bank's policy rate might be expected to reduce inflationary pressures by. How do you reduce inflationary pressure? Will it reduce consumer demand? Will it reduce foreign exchange values or will it drive up asset prices? Obviously, inflation pressure may not be through any of this. Remember, you look at consumer behavior. So consumer behavior will say, I want you to consider reducing the overall consumer demand. Clear? Now, next one. If an economic, guys, last two. If an economy's trend GDP growth rate is 3% and central bank is 2% inflation target, which policy is most common with an expansionary monetary policy? So they will be expansionary. What is better? 2% inflation target, which? So your, what's the answer? GDP is 3%. What do you think the answer could be? Central bank is 2% inflation target. So expansionary policy means the policy will have a rate that is slightly higher or above the rate that's been mentioned. So you have 3% and 2% inflation target, right? So here you'll try to make sure that the rate is somewhere around 4%, okay, based on the growth rate and the inflation target for that company. Okay, if fiscal policy is easy and monetary policy, right? Yeah, if it was easy, so then my grade value monetary policy is tight, which means contraction, and fiscal easy. Then what happened? Interest rates will tend to fall. Interest rates, the government will tend to shrink, or the government will tend to expand. What's the answer?
So the government sector would expand as a proportion.
Very good. Very good answer. When the fiscal policy is easy, government spending increases, right? And tax revenue decreases. So therefore, the government sector would expand because the government sector's income is spending is much higher, right? As a proportional GDP, they are contributing more to it, and that's where it goes. Clear? So this is the motive. See, now the grid I showed you in the end is actually very, very important. This is very critical. Make sure that you learn how to interpret this grid well and then put it down. So that's very critical. Okay. So learn the grid, learn the fiscal policy, learn the output, try to understand how the policy impacts what variables, which variables impacted more. Learn that, understand that, and based on that, you'll get the right conclusion. Clear? Okay, sure. Take care. Study well. Take care, guys. Bye.